A big question in the financial markets has been, are we in an AI bubble? Well, today we will compare the AI environment now to the dot-com era. We also are going to talk about, after a 7-month rally, the stock market has finally had a pullback. We have that and a lot more today. Let's dive into it. Now, before we get into the market update, just a reminder to like and subscribe to our page. That way you don't miss any of our market updates. And just a heads up, next month we have our always popular 2025 recap. All right, let's start off about looking at the question that says, are we in an AI bubble? There are a lot of people who have been saying this for quite some time now. We have some charts that we think are very important. And I want to mention, I started my career at Merrill Lynch in the late 90s, 1998. So I got a good look at the dot-com bubble. That was a real bubble. And when you compare the two, I don't think there is any comparison. The best chart I've put together is here. This is looking at some of the biggest companies in the dot-com era versus now in the AI era. And it's looking at their valuations, how much you're paying for shares of earnings in these companies. So on the far left, you see Qualcomm and Oracle and Cisco. They traded at anywhere between 148 times earnings, that's a PE ratio, to 167 times earnings. Again, those were viewed as kind of three huge winners of the dot-com era. You also see companies that still know. Microsoft traded at 75 times earnings. The NASDAQ, which was made up, it was an index, still is, at that time, all the tech names were there, was trading at 75 times earnings at that time, or 73, I'm sorry, and then Intel at 42. Now in blue, we see companies like Broadcom and NVIDIA. NVIDIA, biggest AI winner by far so far, trading at only 37 times earnings, versus again, Qualcomm, Oracle up at 150, 160 times. There's no comparison there. Then if we look at the NASDAQ itself, currently trading at 33 times earnings, again, versus 73 times back then. So there is just no comparison between the valuations now of a lot of the AI winners and valuations then. Now, that's on valuations. Let's talk about another key difference. One of the big characteristics of the dot-com era was companies that were losing lots of money going to issue debt so that they could build out the telecom, whether it was fiber, the networks all across the country. That was a big piece. And then when the Fed hiked rates, these companies could not afford their debt payments. They started to go bankrupt and their prices plummeted. This time around, we've talked about the big tech names are the ones doing most of the spending. And we're talking about Amazon and Microsoft and Google. Well, these companies are printing gobs of cash in their normal businesses. They're taking some of that money and they're spending to build out own AI, and they believe they're going to have a positive return on that investment. There's no comparison between the two there. Another thing I want to mention is the IPO markets. Back in the late 90s, any company, and it didn't matter if they were a cleaning company, an online bookstore, or anything else, if they said, hey, we have something to do with the internet, and they went public, their stock would go straight up. Well, I have a chart of some of the IPOs that have come public this year. And what we're looking at here, Circle Internet, CoreWeave, Figma, and Bullish. And so these are AI/crypto, some of these companies that came public. What you're looking at is taking a look right now, and there's a lot happening here, so let me break this down. This is looking at today, how far are each of these companies from their highest stock price so far this year. Because if we were back in the dot-com era, these companies would all be going up every day. Instead, you notice that these companies are anywhere between 43% and 73% below their high for the year. The market is discriminating and saying, hey, some companies right now in the AI world have gone up a lot and should be priced a lot higher, but there are some who have dropped significantly because the market's saying, hey, you are not doing as well. That is not bubble behavior. Now, one more chart taking a look at how far a lot of AI winners, companies that have been viewed as AI winners, they went up a lot, how far they've fallen from their highs. So this is a little bit different. I was just going over companies that IPO, that came public this year. These are the AI winners. NVIDIA's there at the top. It's done really well. They had an amazing earnings report last week, by the way. We're filming this on November 25th, but they've dropped 17% off their high just recently. A lot of these other companies on here, Palantir, Iron, CoreWeave, GE Vernova, and you can see they're down anywhere between 15% and 62%. So again, the market's looking at these companies, each one individually, and making judgments. That's what we want to see. Now, the last thing that I'm going to mention on this comparison of the two, like I told you before, that back in the late 90s, there were a lot of companies losing gobs of money who went and issued debt and then started trying to spend that money. We have a small comparison today, and that is Oracle. Oracle was a huge winner back in the dot-com era, and then their stock crashed and went lower over about 15 years. Well, in the last 7 to 10 years, Oracle has started to rebuild, and they are a pretty good business now. But they announced a deal a few weeks ago with OpenAI, which is the ChatGPT owner. It was a $300 billion deal. And when you dug into the details, you found out Oracle was going to have to go issue a lot of debt to build out the capacity so that they could honor the contract with OpenAI. You see the stock price of Oracle over the last 3 years, and the stock soared up to $345 on this announcement, an all-time high. Then take a look over the last week or two. Oracle's stock has plummeted to $193. That is a 45% sell-off. The market is looking at Oracle and saying, hey, this wasn't a very good contract, and you're going to have to issue a lot of debt and build out this network to honor the contract. This sounds a lot like some of the contracts that we got back in 98, 99, 2000. So again, we like to see this. When you add all this up, it tells us we are not in an AI bubble right now. That's good news for the stock market. So the next topic we are talking about, we have finally gotten a stock market pullback. The last few months, we highlighted how the markets have been 3 months, 4 months, 5, 6, even 7 months without any kind of sell-off of significance. Well, we have finally got one in the last couple weeks. The S&P 500 from top to bottom dropped 6%, the NASDAQ 9%. They've started to bounce back a little bit recently, and we'll put the chart of the S&P up. You can see there from April 21st until early November, the markets were going up, up, and away. It was an amazing time frame, and we said this is unusual for the markets to go this long without any kind of sell-off of significance. So I thought, let's actually go back over the last 15 years and see how many occasions the market have been at least 5 months with no sell-off of over 3%. And it's only happened 3 times total, with this time being one of the 3. So let's compare these. The first one that we had, in far as what was the length of the rally, was a little over 5 months. It was the last 2 months of 2023 and the first 3 months of 24. And we talked about these in real time in videos. You can go back and see those. At the end of March, which is when this rally ended, we said, hey, don't be surprised if we get a sell-off out of nowhere, and boom, in early April, that's what happened. That was a gain from late October to late March of 24, 27% rally in the S&P 500, and then we got about a 5.5% pullback rapidly. Then number 2, that was what we just went through, a 7-month rally, as you can see there, a 34% rally along that time. And again, that was after the markets had just dropped 22% over the previous month. So pretty brutal, but this was a nice gain. Most of it was triggered by all the amazing earnings gains that we saw and we talked a lot about, including in our last video. And then number 3 there, which this was the longest rally. This was after the 2016 election, 15 months. The markets went up 37%, and then we got a historical, it was called Volmageddon. The markets dropped 10% in just over a week. That was not a lot of fun. But here's the point is, only 3 times in the last 15 years have the markets gone 5 months or longer with no declines of more than 3%. So we were due for a sell-off. Now it's time for rapid fire. This is when we go through many of the charts that I think you need to know about, and we got a lot of good ones today. Let's start off by talking about the jobs market. The shutdown is over. We now have government data, and they released the September jobs report. They also told us there isn't going to be an October report. We're going to have to wait till mid-December to get November. But we do have the September jobs data, and we had a positive announcement here. 119,000 jobs were created in September. Notice before September, 3 of the previous 4 months had not been very good. May, only 19,000 jobs added. June, a decline of 13,000. July was good, 72,000 jobs added. And then in August, a decline of 4,000. We said all along that time frame, the summer had not been very good for job creation the last couple of years. We wanted to see, as we got into fall, hiring really pick up. Well, September, 119,000, that's what we wanted to see. We just want that to continue when we get November and December's info. We also, on the jobs report, got updated wage growth, 3.79% year over year increase. We would love if the numbers would stay right here. We don't want them going too much higher, because then you get inflation start to become a problem. And if it goes a lot lower, then people aren't getting enough of a wage growth to help them spend. So this is right where you want to see that. Now, the last thing I'll say, not a chart for this, but we also got initial claims for unemployment insurance from the government. 220,000 people filed for unemployment insurance last week. That's on the low end of the range it's been the last 3.5, 4 years. So we continue to be in a low firing jobs market. Now, the next update in rapid fire here is on Bitcoin. And listen, this is a topic that we hear a lot about and get asked a lot of questions when Bitcoin has these parabolic moves higher. This is a Bitcoin chart over the last 5 years, and you'll notice that it's had a lot of periods where it will go straight up, the parabolic move, and then that's when a lot of people put money in Bitcoin, and then it has these big falls. Well, what we've seen recently in the last month or two here, Bitcoin peaked at around $126,000. It is now down into the mid 80s. So here's what I would say. If you were interested in Bitcoin at 120, 125, that wasn't the best place to put money in. Now is a much better time to put money in. The thing is, this is when other people start to want to sell. That's not what you want to do. All right, next topic is on housing. Listen, we heard about this concept of the federal government might back a 50-year mortgage product. This is a terrible idea. And to illustrate that, we had a company do an analysis here and take a look. Right now, if you go out and buy a house, the median priced home these days is $420,000. For a 30-year mortgage, 6.24% is the current rate. You put 20% down. Your monthly payment is just over $2,000 principal and interest, okay? over the life of that loan, you would pay over $407,000 in interest. If you were to go with a 50-year loan, that's the lower scenario here, that lowers the payment just a little over $100 a month. But take a look at your total interest. That's double, $837,000. That is not a good trade-off. Here's the other thing. The first 8 to 10 years, almost all of the payment is going to interest. And we know that a lot of people don't keep their mortgages 8 to 10 years. They either move or refinance. So it would be a terrible idea if it becomes reality, which we really hope it doesn't. Stay away from that. All right, the last chart in rapid fire here is taking a look at the Federal Reserve. We have had 2 cuts in interest rates over the last few months. And at the last meeting, Chair Powell, Jerome Powell, said about December, hey, this is a toss-up. A lot of people thought it was a sure thing that there was going to be another cut. He said, no, that is not the case. Well, in the last couple weeks, we have gotten a move back in the direction. Right now, the market is pricing in an 82% chance of a rate cut, whereas just a week ago, it was only 50% odds of that. So this is what we want to see, another cut. Housing badly needs a cut. So do small businesses. This is telling us the market thinks it's going to happen. So the key takeaway is that while the dot-com era was a definite bubble, there's almost no resemblance to what's taken place in AI this year. We are not in a bubble now. On the stock market, yes, it has had a fall recently, but on the jobs data, that has had a strong bounce back, which tells us the market's not likely to stay down for long. Well, listen, we want to tell you all happy Thanksgiving from us here at Sentara Capital. Thanks for watching and take care.